What's going on, guys? Today we are breaking down a brand new ticker that just hit the market in 2026, vgnt, Versigent plc. This is the Aptiv spin-off that makes the wiring, power distribution, and high-voltage electrical architectures inside your car. Trailing P/E around 7, forward P/E under 6, and the whole company trades at about a third of its annual sales. But before you throw money at it, there is a balance sheet red flag we need to talk about. This is Boondocks Trader. Let's get into it. Audio, 30 seconds. Versigent plc started trading on the New York Stock Exchange on April 1, 2026, after Aptiv spun out its electrical distribution systems business. That division had been designing the nervous system of vehicles for years: low-voltage wiring, signal and data connectivity, power distribution, high-voltage systems for hybrids and EVs, and even EV charging infrastructure. It is based in Schaffhausen, Switzerland, but serves a global customer base across automotive, commercial vehicles, agriculture, and energy grids. Think of it as the company that connects the battery to the motor, the sensors to the computer, and the computer to everything else. Audio, 45 seconds. Here is the bull case. A battery electric vehicle carries roughly 2 to 2.5 times the dollar value of electrical content compared to a traditional gas engine car. As the global fleet transitions, Versigent's revenue per vehicle naturally expands, even if total vehicle units stay flat. The company also benefits from the software-defined vehicle trend: more sensors, more compute, more power distribution, more wiring, more connectors. Management has guided 2026 net sales to $9.4 to $9.6 billion and adjusted EBITDA of $950 million to $1.03 billion. And the stock is priced like a no-growth legacy supplier. Audio, 60 seconds. Let's talk numbers. At around $46, Versigent has a market cap of roughly $3.3 billion. Trailing P/E is about 6.7. Forward P/E is under 6. Price to sales is about 0.35, meaning revenue is nearly 3 times the market cap. EV to EBITDA is around 5.7, while many auto supplier peers trade at 8 to 12 times. It also initiated a dividend, yielding roughly 1%. Wall Street is bullish, 14 analysts cover it, 11 rate it buy or strong buy, 3 hold, 0 sell. The average price target sits around $56 to $57, with the high end near $65. Audio, 45 seconds. The company is not just cheap on paper, it is already over-delivering. Second quarter 2026 revenue came in at $2.44 billion, beating the $2.33 billion consensus. Bookings were strong, around $2.8 billion, and management raised full-year sales and profit guidance. For a brand new spin-off, that is exactly what you want to see. Catalysts going forward include further institutional ownership as the stock gets included in indices and funds, continued EV and hybrid production ramp, and any evidence that management can improve margins and pay down debt. Audio, 45 seconds. Now the part you cannot ignore. Versigent came out of Aptiv carrying a heavy debt load. Depending on the source, debt to equity ranges from roughly 850% to over 1400%. Total debt is around $2.4 billion, while shareholder equity is only about $140 million. The price-to-book ratio is deeply negative. That is the main reason the stock is cheap. The market is saying, yes, you generate cash, but you are leveraged to the hilt. If auto production slows, if an OEM squeezes pricing, or if interest rates stay elevated, that debt matters. This is not a safe blue-chip value play. It is a leveraged cyclical bet. Audio, 60 seconds. Other risks to watch. First, low trading volume. Average daily volume is around 1 million shares, so this can move fast on small news. Second, auto supplier cyclicality. If vehicle sales slump, orders dry up. Third, OEM pricing pressure. Ford, GM, Stellantis, and Tesla are not shy about squeezing suppliers. Fourth, commodity costs. Copper, aluminum, and plastics matter. And fifth, spin-off execution risk. Separating from Aptiv is a massive operational project, and hiccups happen. The bull case only works if management executes and free cash flow goes toward debt reduction. Now here is the update that matters. Recent 13F filings show major institutions are accumulating vgnt. BlackRock reported 11.14 million shares. Geode Capital bought 1.84 million. Vanguard holds 4.24 million. That is roughly 17.2 million shares among just those three. Relative to a 1 million share average daily volume, that is a lot of latent buying power. It likely reflects index inclusion and the end of post-spin-off forced selling. It is a positive near-term tailwind, but it does not fix the balance sheet. Audio, 60 seconds plus 30 seconds equals adjust section timing to 75 seconds. So, what is my take? I am cautiously bullish, but this is a speculative value play, not a core holding. The valuation is genuinely cheap, the end market tailwind is real, and the company is beating expectations right out of the gate. Plus, the recent BlackRock, Geode, and Vanguard accumulation tells us big money is moving in. But that balance sheet is still a serious red flag. If you are going to look at vgnt, size it small, wait for a better entry if you can, and watch the next 2 quarters for debt paydown and margin progress. As always, this is not investment advice. I am not your financial advisor. Do your own due diligence. If you found this useful, like and subscribe. This is Boondocks Trader, and I will see you on the next one. Audio, 45 seconds.